Last week, the Bank of Canada quietly moved to regulate the last financial exit available to ordinary Canadians. The announcement landed without headlines, without warnings. Your retirement portfolio, your 401k equivalent savings, your real estate equity, and your ability to protect wealth during the next currency shock, all of it just got a little harder to defend. And the clock on this is already running. This is not a rumor. This is not a fringe theory. This is a stated policy framework already built, already named, and set for 2026 implementation. And here is the part nobody on television is walking you through right now. The Bank of Canada's new stablecoin oversight regime is not being framed as a restriction. It is being framed as protection. They are calling it consumer safety. They are calling it systemic risk mitigation. But when you look at the mechanism underneath the language, when you follow the legal architecture they have quietly assembled, you arrive at only one conclusion. This is not about protecting you. This is about making sure you cannot move your capital out of a currency that is losing purchasing power at a pace most Canadians have never experienced in their lifetime. In the next 30 minutes, I'm going to show you three things. First, how the Canadian stablecoin framework was constructed layer by layer to give regulators control over the one financial tool that working Canadians were increasingly using to step outside the Loonie. Second, how the Minister of Finance now holds authority to intervene at any point in the digital asset space under the cover of national security, authority that was expanded quietly and that almost nobody reported on. Third, how this entire structure ends with Canadian wealth increasingly trapped inside a domestic currency system that is already under significant devaluation pressure. And by the end, you will understand why this is not about crypto traders or tech enthusiasts. This is about your pension, your savings, your purchasing power, and your ability to make financial decisions before the exit doors close completely. This is already happening, not in the future, right now. To understand what the Bank of Canada just did, you cannot start in 2025. You have to go back to 2023 when Canadian regulators looked at what was happening in the stablecoin space and realized something that alarmed them. Ordinary Canadians, not institutional investors, not hedge funds, were using fiat-backed stablecoins as a simple, accessible tool to move capital out of the Canadian dollar and into USD-denominated digital instruments. No offshore banking accounts, no complex legal structures, just a registered platform and a few clicks. The financial establishment watched the outflow data and understood immediately what they were looking at. Not a technical problem, a capital flight vector. And that is when they began building the fence. But this isn't even the part that concerns me most. What came next was architectural. Between 2023 and 2024, Canadian securities regulators, led by the Canadian Securities Administrators, coordinating across provincial bodies like the Ontario Securities Commission, began issuing guidance that required platforms to seek pre-approval before offering any stablecoin products. Monthly reserve attestations were mandated. Proof of backing requirements were introduced. Some major global exchanges simply stopped offering stablecoin products to Canadian users rather than navigate the compliance burden. The message to the market was clear. If you want to operate here, you operate by our rules. And the rules were tightening. This part is not theoretical. It is observable. The mechanism they built is elegant in a way that deserves careful analysis. Stablecoins in Canada are typically classified as securities or derivatives under Canadian law. That classification is not accidental. It places them under the exact same regulatory umbrella as every other financial instrument that authorities have the power to restrict, gate, or suspend. When you hold a stablecoin on a Canadian registered platform, you are not simply holding a digital dollar. You are holding a regulated financial claim, subject to rules that can be changed, tightened, or invoked at any moment by the relevant provincial or federal authority. The liquidity mismatch concerns regulators raised, the redemption risk language they embedded in official guidance. Those are not technical warnings. Those are legal justifications for future intervention. And here is the detail even professional analysts tend to miss. The Bank of Canada itself has been explicit about its mandate expansion. Under retail payment reforms implemented in recent years, federal oversight powers were extended to cover payment service providers, a category broad enough to include virtually any platform that processes digital transactions involving Canadians. FinTrack compliance, anti-money laundering reporting, registration requirements. These were layered on top of existing securities rules to create a multi-jurisdictional compliance web that operates as a structural barrier to entry. Not a wall, a web, because walls can be climbed. Webs are harder to escape from, and here is where the first domino falls. Think of the structure they have built as a three-floor system. At the ground level, you have the actual stablecoin, a digital token backed by reserves designed to hold value in USD or another foreign currency. This is where real capital preservation value is produced. At the second level, you have the regulated platform, the exchange, the custodian, the service provider, where that stablecoin is bought, held, and transferred. This is where it gets sliced, gated, and controlled by licensing requirements and pre-approval processes. At the third level, you have the policy architecture, the ministerial authority, the national security provisions, the FinTrack reporting chains, where the final power to restrict, suspend, or redesign the entire system sits. As long as all three levels operate normally, Canadians can still use stablecoins as a partial hedge against domestic currency devaluation. But the moment federal authorities decide that systemic risk or national security requires intervention at level 3, the entire structure above it freezes. And you, the Canadian holding a stablecoin on a registered platform, are left with whatever the regulator decides your claim is worth. But once this shifts, everything above it starts to shake. For the average Canadian household, what this looks like on the ground is straightforward. You open your brokerage platform, you look at the Loonie, you watch it decline against the USD. You think about moving a portion of your savings into a USD-backed stablecoin as a simple, low-cost hedge against further devaluation. And you discover that the stablecoin you wanted to hold is no longer available on Canadian platforms. Not because the asset failed, but because the platform pulled it rather than navigate the latest regulatory requirement. The exit you thought existed has already been closed, not by a dramatic announcement, by bureaucratic friction, compliance burden, and quiet market withdrawal. This is the mechanism hiding in plain sight. Let me show you the data that nobody in the mainstream financial press is walking you through right now. In 2023, the Canadian Securities Administrators issued coordinated guidance requiring platforms to obtain pre-approval before listing or continuing to offer fiat-backed stablecoins. That directive alone triggered a visible market contraction. Several major global exchanges, platforms with millions of users, either restricted their stablecoin offerings specifically for Canadian accounts or exited the Canadian retail market altogether. The compliance cost of meeting monthly reserve attestation requirements, custody disclosure standards, and registration obligations was calculated against the revenue potential of the Canadian market. For many operators, the math did not work. And when the platforms leave, the exits close. This is not theoretical. This is already happening. In 2024, oversight powers under the retail payment reforms came into full effect. Payment service providers, a category that now includes crypto platforms, digital wallet operators, and any entity processing digital transactions for Canadians, became subject to mandatory federal registration and reporting. The Bank of Canada's oversight authority over systemically important payment systems, expanded under federal law, now creates a direct regulatory line between the central bank and any platform that reaches sufficient scale. The threshold for what constitutes systemically important is deliberately elastic, which means that as stablecoin use grows, as more Canadians rely on these instruments for wealth preservation and purchasing power protection, the more likely those platforms become subject to direct Bank of Canada oversight. This part is non-negotiable math. Now add the ministerial authority layer. The federal Minister of Finance already holds broad powers to intervene in matters affecting financial stability under Canadian financial law. National security provisions in that same legal framework can be invoked to address risks in the financial system, including, by a sufficiently expansive interpretation, risks related to capital outflows or currency stability. This is not a hypothetical legal stretch. This is the existing architecture. The minister does not need new legislation to act. The tools are already in place. The trigger is simply a decision, and this is the crack that becomes an earthquake. Here is what this means for portfolio risk at the household level. The Canadian dollar floats freely in global markets, and its value is determined by interest rate differentials, commodity price dynamics, and trade flow patterns. Over the past several years, the spread between Canadian and U.S. interest rates, combined with ongoing pressure on Canada's trade position, has created a persistent downward drift in Loonie purchasing power relative to the USD. That drift compounds quietly. It erodes the real returns on Canadian dollar-denominated savings accounts, bond portfolios, and fixed income holdings inside retirement vehicles. For Canadians approaching or in retirement, that erosion is not abstract. It is the difference between a comfortable fixed income and a purchasing power shortfall that grows every year. For the average household, this is what it looks like in practice. You have a pension or an RRSP denominated in Canadian dollars. Its nominal value may be stable or even growing, but its purchasing power, its ability to buy the same basket of goods and services, is declining in real terms as the loonie weakens against currencies tied to harder assets or stronger economies. Historically, retail investors in this position had limited options. They could buy foreign currency denominated mutual funds, expensive, cumbersome, restricted. They could open foreign currency accounts, not widely understood, not accessible to everyone, or increasingly, they could use a stablecoin on a registered platform to hold a portion of their capital in a USD equivalent instrument, simple, accessible, direct. And that is exactly the tool that is now being systematically gated. This is where the cascade becomes unavoidable. Step 1. Regulators increase pre-approval requirements and attestation burdens for stablecoin offerings on Canadian platforms. Step 2. Global exchanges calculate the compliance cost and restrict or exit the Canadian retail market. Step 3. The Bank of Canada expands its oversight mandate to include payment service providers that process stablecoin transactions, bringing them under direct central bank supervision. Step 4. The Minister of Finance, citing systemic risk or national security, invokes existing authority to place additional restrictions on stablecoin redemptions, conversions, or cross-border transfers. Step 5. Canadian retail investors holding stablecoin positions on domestic platforms discover that their ability to convert, withdraw, or transfer those positions has been administratively limited. They do not own a USD equivalent asset. They own a regulated claim inside a system that can gate them at any point. Every single one of these steps has already begun. The sequence is in motion. And here is the part they never put in the official reports. The regulatory framing throughout this entire process has been consistent. Consumer protection, systemic risk mitigation, anti-money laundering compliance. These are legitimate policy objectives in isolation, but the cumulative effect of layering each one on top of the other across provincial and federal jurisdictions simultaneously creates something that goes beyond consumer protection. It creates a structural barrier to capital exiting the domestic currency system, not a prohibition. That would attract too much attention. A friction architecture. Make the exit expensive enough, complex enough, uncertain enough, and most people will not take it, especially people who are not financial professionals, especially people who are already managing mortgage payments, household debt, and the ordinary pressures of daily economic life. For the small business owner, this is catastrophic. You have been running your margins on a loonie that has been quietly losing ground. Your input costs, priced in USD because so many Canadian supply chains sourced from the US, have been rising faster than your ability to pass them on. You were starting to look at digital dollar equivalent instruments as a way to protect your business's cash reserves against further currency erosion. That option is now being systematically narrowed. The tools available to high net worth investors and institutional capital, foreign currency allocations, offshore structures, sophisticated hedging mechanisms remain fully accessible to those with the resources to use them. But for the business owner operating at the retail level of the financial system, the practical options are contracting, but that is not the real problem. The real problem is the logic that underlies the entire framework. Because when regulators in Canada look at stablecoin usage and classify it primarily as a systemic risk and a capital flight vector, when the regulatory architecture is built around controlling outflows rather than protecting the integrity of the instrument itself, they are signaling something important about their own assessment of the domestic currency's trajectory. Healthy currencies do not require fences. Strong monetary systems do not need to control which instruments their citizens can use to preserve purchasing power. The construction of this oversight architecture is itself a data point about what the Bank of Canada and the Ministry of Finance believe is coming. And here is where the second domino falls. The Bank of Canada has publicly researched a central bank digital currency. No retail CBDC has been issued yet. The bank has stated publicly that a CBDC would only be pursued if Canadians demanded it or if cash usage collapsed to the point that a digital alternative became necessary. But read that condition carefully. Cash usage collapsing is not a demand condition, it is an infrastructure condition. And as digital payments increasingly dominate Canadian retail transactions, as stablecoin access is systematically gated, the conditions for a CBDC become more plausible, not less, not because Canadians are demanding it, but because the alternatives are being quietly removed. This is the mechanism that has been hiding in plain sight. Now, let us talk about why most Canadians will not act on this until it is too late. And this is where the analysis gets uncomfortable. The first mental trap is normalcy bias. The loonie has been declining against the USD gradually enough that most Canadians have not registered it as a crisis. A slow devaluation does not feel like a crisis. It feels like prices going up a little. It feels like travel getting more expensive. It feels like import costs rising. But the brain does not translate that gradual drift into a "my retirement savings are under systemic pressure" signal, because the nominal account balance in Canadian dollars is still growing. The money illusion is active. You see the number going up and assume that wealth is being preserved. What you are not seeing is the silent debasement happening underneath that number. And this part is not a prediction, it is math. If you hold a Canadian dollar denominated pension or RRSP and the Loonie loses 5% of its purchasing power relative to the USD over the next 3 years, which is a conservative projection based on current interest rate differentials and trade dynamics, you have experienced a 5% erosion in your real retirement security, even if your nominal balance increased. For someone with $300,000 in retirement savings, that is $15,000 in purchasing power gone, silently, without a headline, without a market crash, without anything that triggers the psychological alarm that tells you to act. The second trap is authority deference. When the Ontario Securities Commission issues guidance requiring monthly reserve attestations for stablecoin offerings, most Canadians hear that as a technical regulatory update, not something relevant to their portfolio. The language of securities regulation is designed to sound technical and neutral, but when you translate it into plain terms, we are now requiring any platform offering digital dollar alternatives to submit to ongoing government supervision of their reserves. The implication becomes much clearer. The people who hold power in the Canadian financial system are building oversight infrastructure around the exact instruments that would allow ordinary Canadians to step outside that system. This is not a conspiracy, it is a stated policy. The third trap is the false equivalence between regulation and safety. When media coverage of Canadian stablecoin regulations frames tighter oversight as protecting consumers from risky digital assets, it is not inaccurate in a narrow sense. Stablecoins do carry risks, reserve mismatches exist, foreign projects have collapsed, but the regulatory framework being constructed in Canada does not distinguish between a poorly collateralized offshore stablecoin and a fully reserved, audited, institutionally operated digital dollar instrument. The compliance burden applies uniformly. The effect is not that risky stablecoins are weeded out and safe ones remain accessible. The effect is that the market contracts overall, exits narrow, and the people who needed those exits for genuine wealth preservation purposes are left with fewer options. But here is where it gets worse. Because the Canadian regulatory framework is not being built in isolation. The United States, the European Union, and the United Kingdom are all tightening stablecoin oversight simultaneously. This is coordinated global policy momentum. The G7 financial stability framework has been pushing for convergence on digital asset oversight for years, which means that the thesis that Canadians can simply use non-Canadian platforms to access stablecoin instruments as a capital preservation tool is also under pressure. The compliance walls are rising on multiple fronts at the same time. High net worth investors with sophisticated legal and financial advisory teams will navigate this. They always do. They will access foreign currency allocations through structures that remain legal and functional under any foreseeable regulatory scenario. The wealth protection tools available at the top of the financial system are not going away. But for the middle-class Canadian managing a mortgage, servicing debt, trying to protect the purchasing power of their RRSP, the accessible low-cost tools are being gated one by one. And here is the part that should concern every person watching this. The real estate dimension of this story has not been discussed enough. Canadian households carry some of the highest mortgage debt loads relative to income in the developed world. The real estate market stability is directly tied to the interest rate environment, which is itself tied to the Bank of Canada's monetary policy decisions, which are themselves constrained by the relationship between the Loonie's value, inflation dynamics, and the capital flow pressures that stablecoin usage was beginning to create. When Canadians move capital out of Loonie-denominated instruments into stablecoin equivalents, even in modest amounts, that creates downward pressure on domestic monetary aggregates. It is a micro-scale version of capital flight. And the Bank of Canada, whose mandate includes payment system stability, is clearly watching those flows. The stablecoin framework is, in part, a mortgage market protection mechanism. Because if capital flight accelerates, the Bank of Canada faces harder choices on interest rates, and harder interest rate choices mean higher mortgage costs for millions of Canadians. The feedback loop is direct. The connection between stablecoin regulation and your mortgage payment is real. And here is where the cascade reaches the individual. Let me be precise about what the credit and debt stress dimension looks like. Canadian household debt as a percentage of disposable income has been running at historic highs. Consumer credit markets are exposed to any significant shift in interest rate policy. If the Bank of Canada is forced, by currency pressure, by capital outflow dynamics, by inflationary persistence, to maintain higher rates for longer, the debt servicing burden on Canadian households increases. The people most exposed are the ones carrying variable rate mortgages and high levels of consumer credit. Those are not wealthy investors with diversified portfolios. Those are ordinary Canadians who are already running tight. And if the stablecoin framework removes one of the practical tools they might use to hedge their currency exposure, the pressure on those households tightens further. This was inevitable the moment the regulatory architecture began treating digital capital preservation tools as systemic threats rather than legitimate financial instruments. Now, let us talk about what this means for your portfolio and how to think about it clearly. I cannot tell you what to do with your specific financial situation, but I can give you the only question that actually matters in this environment. Do you own the asset or do you own a claim on the asset? If you hold a stablecoin on a registered Canadian platform, subject to pre-approval requirements, reserve attestation mandates, ministerial intervention authority, and FinTrack reporting chains, you own a regulated claim inside a system that can gate, restrict, or redesign your position at any point. The claim exists at the pleasure of the regulatory architecture surrounding it. If you hold assets in forms that exist outside that architecture, foreign currency accounts through direct bank channels, allocated foreign assets held under structures that predate or operate outside the new compliance framework, diversified portfolio exposure to international equities and hard assets, the gatekeeping architecture applies differently. The question is not whether stablecoins are good or bad. The question is whether the instrument you are using to protect your purchasing power lives inside the regulatory perimeter that is currently being tightened or outside it. In every major historical instance where a currency faced sustained devaluation pressure and the government responded with oversight architecture around capital preservation instruments, the people who protected their wealth were not the ones with the most sophisticated charts. They were the ones who moved from regulated claims to real asset exposure before the compliance architecture reached its final configuration. The architecture here is not complete. The 2026 implementation timeline has not arrived. The ministerial intervention powers have not been activated, but the structure is built, the legal tools are in place, and the direction of travel is unambiguous. This is not a prediction. The data forces one conclusion. Portfolio rebalancing in this environment requires a clear-eyed assessment of currency risk as a first-order consideration, not an afterthought. For Canadians with significant RRSP or RRIF exposure, the yield curve dynamics between Canada and the US, where Canadian rates have been under ongoing pressure relative to American equivalents, represent a structural real returns challenge that compounds over time. Asset allocation reviews that do not explicitly account for Loonie purchasing power erosion are performing an incomplete analysis. Duration risk in Canadian dollar denominated fixed income instruments is a live concern in an environment where the currency itself is under devaluation pressure. Wealth preservation in this context means actively understanding where your capital sits in the regulatory and currency architecture, not assuming that nominal stability equals real security. The Bank of Canada blamed this on consumer protection. They called it systemic risk mitigation. They framed it as regulatory modernization. But you now understand what the architecture actually does. The system did not stumble into this framework by accident. It was designed layer by layer to ensure that the capital preservation tools accessible to ordinary Canadians remained inside the regulatory perimeter of a currency that is losing ground. The fence was built before the devaluation became undeniable, and the fence is almost finished. In the next episode, we are going to look at how governments historically respond when the gap between official currency narratives and real purchasing power dynamics becomes impossible to manage, and the three mechanisms through which wealth is typically transferred from retail savers to institutional capital during that transition. Stay vigilant, stay informed, and above all, understand what you own and what owns you.